Hello, I'm David Cassidy with the weekly market summary for the week ending Friday, the 18th of September. Well, the week's Fed monetary policy meeting was like an underwhelming party in that it was disappointing, but hard to say exactly why. And as a result, after a promising start to the week, global equity markets reversed course and ended the week very slightly lower. Now, we have long argued that interest rates will remain low for the foreseeable future, and so it was pleasing that the US Central Bank stated that it would keep US interest rates near zero for at least 3 years, despite the projections that the economy will be growing strongly by then. The Fed was able to make this commitment because they recently changed their inflation target from 2% to one that averages 2%, and as such they will allow inflation to overshoot 2% to make up for time it has spent running below 2%. And as we've previously said, the Fed's favoured inflation measure, the core PCE reading, has averaged just 1.6% over the past 10 years and is currently just 1.3%. Although the US economy is performing much better than we expected just a few months ago in terms of GDP, unemployment and inflation, and we've been amongst the most positive commentators, it was disappointing that the Fed stopped short of increasing monetary stimulus, such as expanding quantitative easing, QE, or using negative interest rates, and instead put the emphasis on Congress to provide fiscal stimulus to help those American workers that have been hard hit by the coronavirus outbreak and associated lockdowns, as we believe this is looking increasingly unlikely before the US presidential elections on the 3rd of November, given the current standoff between Republicans and Democrats. However, what was very interesting to us was the fact that the Fed made increasing US interest rates conditional on inflation running above 2%, as well as achieving maximum employment. Hitting one of these targets in the next 3 years will be a challenge, and hitting both at the same time seems like an extremely big ask. Consequently, we wouldn't be surprised if 2023 turns out to be way too optimistic for the Fed's next interest rate increase, especially when you consider that after the 2008-2009 global financial crisis, US interest rates were left unchanged for 7 years. This is exceptionally positive, as a loose monetary policy has been and will continue to be very supportive for global equity markets. It was a similarly underwhelming story in the UK. Thursday, the 17th of September, showed us that the Bank of England's meeting, which could have been a watershed BOE meeting, ended up as a yawn as nothing significant materialised. While we fully expected that the Bank of England would leave interest rates unchanged at 0.1% and its QE asset purchase programme at £745 billion, we had hoped for firm stimulus signals, negative interest rates and or more QE, especially after last Wednesday's UK CPI inflation data. As we forecast last month, UK inflation fell sharply from 1% in July to just 0.2% in August, its lowest reading since December 2015. Although we believe that UK inflation is likely to rebound slightly in September, as much of this dramatic fall was driven by the government's Eat Out to Help Out scheme, which is now finished, we still expect inflation to remain subdued and, indeed, well below the Bank of England's 2% target. Although we didn't get a clear commitment from the Bank of England, we believe it is only a matter of time, potentially before the end of this year, before policymakers cut UK interest rates to below zero, given low inflation, a weakening employment market, a resurgence in coronavirus cases and Brexit uncertainty. And as with the Fed, any dovish evolution in the Bank of England's narrative will be very positive for equity markets. Elsewhere, US jobless data indicated that the economic rebound is continuing as initial jobless claims decreased by 33,000 to 860,000, while continuing claims, the total number of Americans on unemployment benefits, fell by more than 900,000 to 12.63 million. This now means that the US economy has recouped roughly half of the coronavirus lockdown-induced job losses. Additionally, Friday's University of Michigan Sentiment Index showed that US consumer confidence increased to a 6-month high, indicating that Americans are upbeat about the US economy's prospects. Looking at the week ahead, of main interest to us will be US, UK and Eurozone PMI, US mortgage applications, US home sales, US weekly job losses claims data, and UK and Eurozone consumer confidence. Now, global equity markets have started the week in negative territory, with the FTSE 100 currently down over 200 points or around 3.4%. Given the cacophony of market noise, it would be easy to simply blame this on the news headlines, given all the talk of potential new UK lockdown restrictions, as these could hurt consumer confidence, especially as shares in travel and leisure companies have seen outsized negative moves today. For example, IAG, the owner of British Airways, has been trading down around 13%. Of course, the causation of today's weakness isn't quite that simple, as the resurgence of coronavirus isn't new news. In fact, we believe today's weakness in global equity markets actually relates to the death of US Supreme Court Justice Ruth Bader Ginsburg, as this has the potential to inflame the current political standoff between Republicans and Democrats, and thus further reduce the chances of the two sides agreeing on a new fiscal stimulus package. While we appreciate today's weakness is unpleasant, and it is very important to remember that equity markets often tend to overshoot on both the upside and the downside, and so it's best not to get caught up in the day-to-day noise of the market and instead maintain a long-term perspective. Although the death of Ruth Bader Ginsburg has brought into focus this political friction ahead of what was already looking like being a very contentious US presidential election campaign, as we've previously argued that a new US fiscal stimulus package was looking increasingly unlikely before the US presidential elections on the 3rd of November. Unfortunately, despite the fact that the economic data clearly indicates that the global economy is recovering, equity market volatility is likely to remain elevated in the short term, as the tug of war between this economic recovery versus both the US elections and the coronavirus will yo-yo equity markets.